I want to start by acknowledging something that rarely gets said out loud, especially in markets like this. It's not fear that wears people down. It's not even sharp crashes or dramatic headlines. It's the tiredness, the boredom, the quiet discouragement that creeps in after months and years of waiting, watching, checking, hoping, and then feeling nothing really change. If you've been holding XRP for a long time, there's a specific kind of mental fatigue that comes with that experience. It's not panic. It's not anger. It's the low-level exhaustion of feeling like you've been patient long enough, thoughtful long enough, disciplined long enough, and yet the market seems uninterested in rewarding that effort. That feeling is real. It's human. And it does not make you foolish, weak, or naive. It makes you honest. Most people imagine that investors quit because they're scared. In reality, most people quit because they're tired. They quit because the emotional energy required to keep believing quietly without validation, without excitement, without visible progress, slowly drains away. Sideways movement does that. Slow grinding action does that. Repeated small disappointments do that. You can endure a crash if you believe it has meaning. You can survive volatility if it feels purposeful. What's much harder to endure is stagnation that feels pointless. And yet, paradoxically, that is exactly the environment where long-term positioning is most often built. If you found yourself questioning not just the asset but your own judgment, that's not a sign that something is wrong with you. It's a sign that you're being placed under a psychological test. Markets are not only mechanisms for price discovery. They are systems designed to test human behavior. They test patience more than intelligence. They test emotional regulation more than conviction. And they test whether someone can sit with uncertainty without demanding immediate resolution. It's important to say this gently but clearly. Most people who fail in markets are not wrong about the long-term story. They exit at the wrong moment emotionally. They leave not because their thesis collapsed, but because their nervous system did. They trade long-term opportunity for short-term emotional relief. That relief feels like clarity at the time. It feels like finally doing something. But in hindsight, it's often just exhaustion making decisions. When people think about why investors fail, they usually imagine panic, fear, or sudden crashes that wipe out confidence in a single moment. But in reality, fear is rarely the thing that causes long-term investors to walk away. What breaks most people is something much quieter and much slower. It is emotional exhaustion. It is the fatigue that comes from waiting through long stretches where nothing seems to happen, where price drifts sideways, where hope is neither confirmed nor destroyed, just slowly worn down. This kind of environment doesn't shock you out of a position. It drains you out of it. An investor can survive volatility if it feels purposeful. Sharp moves, even downward ones, create a sense that the market is alive and responding. But long periods of stagnation are different. They force you to carry uncertainty every day without resolution. You check the chart, read the news, listen to opinions, and still end up with the same unanswered questions. Over time, this constant low-level pressure begins to affect judgment. You start to question not just the asset, but yourself. You wonder whether your patience is wisdom or stubbornness. That inner dialogue is the real battleground. This is where many investors confuse relief with clarity. Selling during exhaustion often feels like finally taking control, like lifting a mental weight that has been pressing down for too long. But that feeling is not strategy. It is the nervous system asking for rest. Markets are designed to create these moments because they know that tired minds make different decisions than calm ones. When energy is depleted, long-term thinking weakens, and short-term comfort becomes more attractive. The difficult truth is that most people do not exit because their original reasoning collapsed. They exit because they can no longer emotionally carry the weighting. That distinction matters. It explains why so many investors sell near periods of transition rather than during obvious failure. Exhaustion makes silence feel dangerous even when nothing is actually breaking. Understanding this changes how you see the moment you're in. Instead of interpreting fatigue as a signal that you were wrong, you begin to see it as part of the process. Markets test patience deliberately. They reward those who can recognize exhaustion without letting it make decisions on their behalf. The goal is not to feel confident every day. The goal is to remain clear enough that tiredness does not replace judgment. Most people believe that opportunity shows up with noise, excitement, and a sense of urgency. They assume that when something truly matters, it will feel obvious, validated, and widely discussed. But markets rarely work that way for those who benefit most from them. The environments that reward long-term investors are usually quiet, uncomfortable, and emotionally unrewarding. This is because capital that thinks in years rather than days does not wait for excitement. It moves when attention is low and confidence is thin. Excitement is not a signal of value. It is a signal of participation. By the time a market feels exciting, many decisions have already been made beneath the surface. Price begins to move only after positioning has taken place, not before. Long-term capital understands this, which is why it is willing to act during silence, boredom, and doubt. It does not need constant reassurance because it is not trying to be entertained by the market. It is trying to be aligned with structure. Short-term participants, on the other hand, are emotionally wired to wait for confirmation. They want price to prove the idea, for narratives to feel safe, and for consensus to reduce discomfort. This approach feels logical, but it often leads people to enter late and exit early. When excitement fades, they interpret the absence of stimulation as risk, even when nothing structurally has changed. This is how boredom becomes a trigger, not because something is wrong, but because attention is no longer being rewarded. Quiet periods are misunderstood because they offer no emotional payoff. There is no applause for waiting, no validation for staying calm while others disengage. Yet this is exactly why these periods matter. When fewer people are watching, ownership consolidates. When narratives feel tired, pressure is released from the system. When urgency disappears, discipline becomes visible. An investor who understands this learns to reinterpret discomfort. Silence is no longer threatening, it becomes informative. Lack of excitement stops being a warning and starts being a clue. The market is not asking for reaction in these moments. It is asking for restraint. Wealth, in its earliest stages, rarely announces itself. It grows in places where patience feels hardest to justify. The challenge is not intellectual. Most people understand this conceptually. The challenge is emotional. It requires accepting that the most important work is often happening when it feels like nothing is happening at all. Long-term investors are not rewarded for being loud or fast. They are rewarded for being present during the moments everyone else finds too dull to endure. One of the most difficult lessons for an investor to truly absorb is that price is rarely the leader. It feels like the leader because it is the most visible and emotional signal, but in reality, it is a follower. Price reacts to forces that take shape long before any movement appears on a chart. This misunderstanding causes many investors to doubt their positioning during long, quiet periods because they are watching the last piece of the puzzle and expecting it to move first. Before price responds, structure has to exist. Systems must be built, tested, and aligned. Rules must be clarified, pathways must be established, and liquidity must have a reason and a route to move. None of this creates daily excitement. None of it produces clear confirmation in real time. In fact, most of it looks like nothing at all from the outside. This is why waiting feels so unproductive, even when meaningful progress is happening beneath the surface. Investors often assume that if something were truly developing, they would feel it through price action. But markets do not reward awareness in that way. By the time price reflects structural change, it is no longer early. The market has already adjusted internally, and the visible move is simply the final expression of a process that began much earlier. Expecting price to move first is like expecting the echo BEF, or the sound. This creates a psychological trap. During long periods of slow movement, investors begin to interpret stillness as failure. They question whether infrastructure really matters, whether preparation is actually happening, or whether the narrative they once believed has quietly broken. In reality, stillness often means alignment is forming. Systems do not rush. They integrate slowly because they are designed to last. Long-term investors learn to shift their focus away from daily price signals and toward understanding sequence. They recognize that price is confirmation, not initiation. When you internalize this, waiting becomes easier to tolerate. You stop demanding immediate proof and start respecting process. The urge to react weakens because you no longer expect the final outcome to appear before the groundwork is complete. This perspective does not eliminate doubt, but it softens it. It replaces urgency with patience and anxiety with context. When price eventually responds, it often feels sudden, but only to those who are watching the wrong thing. For those who understood that price moves last, the change feels less like a surprise and more like a natural conclusion to a long, quiet build. Long-term opportunity is rarely lost in moments of chaos. It is usually lost in moments of mental overload, when an investor's attention is constantly pulled in every direction by price updates, opinions, news cycles, and speculation. The ability to think clearly begins to erode. This doesn't happen all at once. It happens slowly, through repeated exposure to uncertainty without emotional recovery. Over time, reactivity replaces reflection, and decisions become driven by discomfort rather than understanding. Markets generate an endless stream of signals, but not all signals deserve equal weight. Constant monitoring creates the illusion of control, while Act 2, weakening judgment. The mind starts to interpret every small movement as meaningful, every pause as a warning, and every delay as a threat. In this state, even disciplined investors can find themselves questioning long-term convictions simply because their nervous system is overstimulated. Calm thinking becomes difficult not because the situation is urgent, but because the mind has not been allowed to rest. An investor who learns to step back gains a critical advantage. Distance restores perspective. Reduced exposure to noise allows patterns to re-emerge. Instead of reacting to each fluctuation, the investor begins to observe the broader environment, recognizing that long-term positioning does not require constant action. This shift is not about ignoring reality. It is about choosing which parts of reality deserve attention and which only drain emotional energy. Calm is not passive. It is active restraint. It is the deliberate choice to protect clarity in an environment designed to fracture it. When reactivity decreases, decisions become slower, but also stronger. They are no longer shaped by the need for immediate relief, but by alignment with long-term thinking. This is where opportunity is preserved, not created but protected from being abandoned prematurely. Many investors believe that staying engaged means staying informed at all times. In practice, over-engagement often leads to poorer outcomes. The investor who survives long cycles learns when to observe and when to disengage emotionally. This balance allows conviction to remain intact even when external signals feel confusing or contradictory. In the end, the greatest risk is not missing a move. It is losing composure before the move arrives. Calm thinking keeps options open. Emotional exhaustion narrows them. By learning to regulate attention and reduce unnecessary reactivity, an investor does not predict the future. They simply ensure that when opportunity eventually becomes visible, they are still present, clear-minded, and capable of responding from strength rather than fatigue.